Hi everybody, and welcome back to video number 3 in chapter 16. And when we left off, Webb Corporation had this unrealized loss of $9,537. So what we're going to do is create a credit for that. Now, it makes an adjusting entry to a valuation allowance to record the decrease in value and to record the loss as follows on December 31, 2025. It had an unrealized holding loss of $95.37 and a fair value adjustment credit $95.37. Now, if the company sells the bonds before the maturity date, it must make entries to remove from the debt investment accounts the amortized cost of the bonds sold. So any realized gain or loss on sale is reported in the other section of the income statement. Okay, let's take a look at that. Now, the Webb Corporation sold the Watson bonds on July 1st, 2026 for $90,000, and at which time it had amortized cost of $94,214. So if we subtract those two numbers, we get a loss on the sale of bonds of $4,214. So we're going to debit cash for $90,000 because that's what we received, and then we're going to show a debit loss on sale of investments of $4,214 and a credit to debt investments of $94,214. Now, assuming no other purchases and sales of bonds in 2026, Webb on December 31, 2026 prepares the following information, and you can see the amortized cost remaining here, and the fair value was $195,000. That was the unrealized loss of $5,000. The previous fair value adjustment, which we just did, was the $9,537 loss. So the fair value adjustment here, we need to take the difference between the $5,000 and the $9,537, which is $4,537, and make a fair value adjustment for that difference. And you can see from this T account here, initially we had the $95,337 credit for that. We made an adjustment of $95.37, which takes the balance in the fair value adjustment account down to $5,000. Okay. And so we debit fair value adjustment for $4,537 and credit unrealized holding gain or loss dash equity for $4,537. Okay, so on Webb's balance sheet, if we look at investments, we have debt investments available for sale, $195,000. We have stockholders' equity, where we have the $5,000 accumulated other comprehensive loss. And then on the income statement, we have other revenues and other expenses and losses. That's where we'll record the loss on the sale of investments of $4,214. You can see that's relatively complex. So you're going to probably have to study that a little bit on your own. Okay, trading securities. fair value through net income. The companies report trading securities at fair value with unrealized holding gains and losses reported as part of net income. Any discount or premium is amortized. So a holding gain or loss is the net change in fair value of a security from one period to another, exclusive of dividend or interest revenue recognized but not received. Okay, let's take a look at an example. Here, we're going to assume on December 31, 2025, Venture Publishers determined its trading securities portfolio to be as follows. And we're going to assume that 2025 is the first year that Venture Publishers held those trading securities. So here they all are: municipal bonds, treasury bonds, certificates of deposit. And we have our amortized cost and fair value. So if we ripple that through, unrealized gains or losses are shown as follows. And in total, we have a $3,750 unrealized gain. Okay, so the question therefore is, what entries should Venture make to record these securities at December 31, 2025? And here's what we would do. The total cost of the Venture's trading portfolio is $314,450. The gross unrealized gains are $12,780, and the gross unrealized losses are $9,030. And so that results in a net unrealized gain of $3,750. The fair value of the trading securities is therefore $3,750 greater than its amortized cost. So it's going to make an adjusting entry to the fair value adjustment account to record both the increase in value and the unrealized holding gain. So that will be a debit to fair value adjustment and the credit here to the unrealized holding gain or loss dash income account. And because the fair value adjustment account balance is a debit, Venture Publishers adds it to the cost of the debt investments account to arrive at a fair value for the trading securities. Venture Publishers reports this fair value amount on the balance sheet. The term income in the account title unrealized gain or loss dash income indicates that the gain is reported in net income. Okay. So let's put all this into practice. The Rogers Corporation holds the following bond investments, which were purchased in 2025. They purchased some here on April 1 and some on July 1. Here we have government bonds, and here we have driver company bonds. Okay, they want you to alpha, prepare the entries when the bonds were purchased. So I'm going to bounce ahead and we'll look at how we would do that. Here, we would debit debt investments available for sale here at $100,000 and credit cash on April 1. And similarly, on July 1, we would debit debt investments for $50,000 and credit cash to pay for it, $50,000. So that is the amount we paid as shown. Now under Bravo here, we're going to prepare the entry to record the accrued interest on December 31, 2025. And how we calculate that is here, the U.S. government bonds, which we purchased in July and paid for in December on April 1, 2026. So we take the 100,000 times 5% times 3/12, October through December, and we get $1,250. And then for the driver company bonds, we had the full 6 months there from July to December. So we take $50,000 times 6% times 6/12 gives me $1,500. Together, $2,750. So we debit interest receivable and credit interest revenue. Okay. Now, notice here under the government bonds that the interest was payable on April 1 and October 1. So in the case of that interest, we had to take it from October, November, and December, not from April 1. Okay, under Charlie here, the fair values of the securities on December 31, 2025 were the U.S. government bonds of $124,700 and the driver company bonds of $58,600. What entry or entries, if any, would you recommend to be made? Well, under Charlie here, we're going to debit the fair value adjustment for $33,300 and credit the unrealized holding gain of equity of $33,300. And we get that number because the cost was $150,000 and together the fair values were $183,300. And because nothing had happened before that, we don't have a previous fair value adjustment balance, so that we take the entire amount to the fair value adjustment. Okay, now under Delta, the U.S. government bonds were sold on July 1, 2026 for $119,200 plus accrued interest. What would be the proper entry for that? Okay, so for Delta, we're going to take the cash here. We have some accrued interest of $1,250. That's 100,000 times 5% times 3/12 because we're selling it, right, in July. And then we're going to have cash of the $119,200 plus $1,250, or $120,450. The debt investments available for sale, the original $100,000 will zero out. Interest revenue, $1,250, and the gain from the sale would be that differential. Now, under Echo, briefly describe how the accounting in Part C for these investments would change if the securities are classified as held to maturity and trading. Okay, so if we look at that, if it's held to maturity, under Echo here, the bonds are accounted for at the amortized cost with no fair value adjustment. Therefore, there is no journal entry required for Part C, Charlie. And then number 2, if classified as trading, the bonds are accounted for at fair value with any unrealized gains and losses recorded in income. So the account credited in the entry for Part Charlie is unrealized holding gain or loss dash income. Okay, that looks like a good place for us to stop this video, and when we continue, we'll take a look at describing the accounting for investments in equity security. Until that time, bye for now.